Hey everyone, let's dive into some shocking news that's currently stirring the stock market. Nvidia has officially sold off all its shares in Serve Robotics and SoundHound AI, resulting in dramatic drops in their stock prices by over 40% and 30% respectively. But instead of immediate panic, is it time to explore the potential for upcoming investments? In this discussion, we will unravel Nvidia's decision, examining the implications for the stock market, and if these companies remain worthwhile investments for current or prospective shareholders. Recently disclosed in Nvidia's latest Form 13F filing, this crucial announcement certainly caught many by surprise. While the filing covered the quarter ending December 31, 2024, the public revelation came as a shock to investors who had seen Nvidia's prior endorsements of both Serve Robotics and SoundHound AI. The aftermath of this announcement was swift, as Serve Robotics suffered a staggering 41% drop, while SoundHound AI experienced a notable 27.6% decline. This downturn was largely fueled by widespread investor anxiety and concerns over Nvidia's motivations behind the divestment. Previously, Nvidia's involvement in these companies was perceived as a vote of confidence, driving their stock prices upward as investors were optimistic about the future potential. Their holdings illustrated not just financial backing, but a belief in innovative technology and growth prospects for both firms. Now, as Nvidia completely exits its stake, the landscape shifts dramatically. The complete withdrawal from Serve Robotics and SoundHound AI signifies a serious divestment rather than a mere portfolio adjustment, leading many investors to assume the stocks have lost their value entirely. However, this may not be as clear-cut as it seems. The market can often react impulsively, overestimating the significance of Nvidia's exit while underappreciating the underlying potential of these companies. There may be solid reasons why these stocks could still thrive, especially if other factors within the industry remain strong. Investors must keep in mind that market opinions can shift, creating chances to buy at lower prices for innovative technologies. In conclusion, while Nvidia's decision to fully divest from Serve Robotics and SoundHound AI has understandably caused alarm, viewing this situation through a strategic lens may reveal hidden opportunities for future gains. Is the panic surrounding these stocks justified, or is it simply a transient upheaval in the market? Perhaps the best course of action is to analyze the fundamentals and consider whether this is the moment to seize an advantageous position before the market stabilizes. In the unpredictable world of investments, the behavior of retail investors often sways the market. Many retail investors tend to mimic the actions of large institutional investors, assuming that their insights are infallible. This blind reliance can lead to adverse outcomes, especially when institutional decisions are based on factors beyond simple stock valuation. For instance, Nvidia's initial investment sparked a flurry of purchases from traders who eagerly bought shares in anticipation of a rising tide, without diving into the underlying fundamentals of the companies involved. However, when Nvidia decided to sell its shares, a wave of panic swept through the market. Retail investors, having not conducted their own analyses, followed suit and offloaded their shares. This knee-jerk reaction dramatically impacted stock prices, showcasing the perils of following the herd. While institutional investors may buy or sell for strategic interests and risk management, their motivations often remain obscure to everyday investors, exacerbating the risks of blind following that can lead to significant losses. Turning to individual stock evaluations, SoundHound AI's case exemplifies the importance of diligent analysis. A discounted cash flow (DCF) valuation positioned the intrinsic value of SoundHound AI's stock at approximately $3.88 per share. Even with the recent dip to $11, its stock is still considered overvalued, highlighting a disconnect between price and performance. Despite the company's strong offerings in AI-driven voice recognition technology, the existing stock price fails to reflect its financial health and growth prospects, indicating it is not an optimal investment at this moment. Similarly, an overview of Serve Robotics reveals a similar theme. While a comprehensive DCF analysis was lacking, past evaluations suggested that its stock was overpriced. Operating with autonomous food delivery robots in bustling urban areas, the company showcases impressive technology and potential. Yet, as with SoundHound AI, compelling innovation cannot justify an inflated stock price. The exuberance surrounding these companies reflects a trend in the market. Promising technologies can fuel excitement, but sound investment should always be grounded in robust analysis and rational valuations. Ultimately, the inclination to follow institutional giants like Nvidia can lead to perilous outcomes. Both SoundHound AI and Serve Robotics serve as cautionary tales, illustrating that creative innovation alone does not always translate to worthy investments. Retail investors should strive for a balanced approach, combining market insights with thorough research to navigate the complex world of equity markets effectively. In the dynamic world of investments, discerning the right path can often feel overwhelming. One key takeaway for investors is that the actions of influential companies, such as Nvidia, should not dictate personal investment decisions. It's crucial to remember that Nvidia's recent exit from certain stocks does not inherently signal that those assets are poor investments. Large corporations engage in stock transactions for myriad reasons, often rooted in strategic realignment or broader financial planning beyond mere valuation assessments. It is vital for investors to carve out their own understanding through diligent research before finalizing investment choices. When evaluating potential investments, several critical factors must come into play. First and foremost, the financial health of the company must be scrutinized. This encompasses analyzing revenues, earnings, and debt levels. Market potential and competitive positioning also offer insight into how a company might perform in the future. Additionally, investors should contemplate the long-term business strategy and scalability of the firm, alongside essential stock valuation metrics such as PE ratios and discounted cash flow analyses. Emphasizing fundamental analysis when making investment decisions provides a much more stable approach compared to impulsive reactions to fleeting news and market sensations. In light of the recent price dips, caution remains prudent. Notably, companies like Serve Robotics and SoundHound AI, despite substantial declines, are still trading above fair valuation levels. This leads to a hold recommendation, suggesting that while these stocks aren't attractive buys currently, neither should they be hastily sold off. However, as prices trend downward, a future scenario may arise where these stocks become fairly valued or even undervalued, presenting enticing investment opportunities. Factors such as stronger financial performance, with heightened revenue growth and improved profitability, alongside strategic partnerships that expand market potential, could shift the investment landscape favorably. Investors should keep a vigilant eye on these stocks, yet resist the urge to invest until warranted by improved valuations. Ultimately, the overarching message is to allow genuine research and analysis to steer investment strategies rather than momentary market movements. It's easy to be influenced by rapid stock price changes driven by major players' actions, but wisdom lies in assessing intrinsic value without succumbing to external noise. The investor who remains steadfastly focused on long-term fundamentals typically outshines those who react impulsively to daily news cycles. To enrich your investment journey further, subscription-based resources such as comprehensive stock research and valuation models for over 125 companies offer invaluable guidance. Stay informed, remain patient, and approach your investments with a discerning eye. Nvidia's recent decision to divest from Serve Robotics and SoundHound AI has sparked a notable stir in the investment community. As shares of these companies plummeted, a wave of panic among investors ensued, prompting many to hastily sell off their stocks. This immediate reaction raises questions about the implications of such moves by a major player like Nvidia, identified for its strategic investments and foresight in the tech landscape. However, it is crucial to analyze whether Nvidia's actions reflect negatively on Serve Robotics and SoundHound AI's viability as investments. The mere act of selling shares should not serve as a definitive indicator of a company's financial health or future potential. Many investors may overlook the fact that an institution's internal strategy can stem from various reasons that do not necessarily correlate with these assets' fundamental strengths. Even in light of recent price drops, it's essential to recognize that both Serve Robotics and SoundHound AI remain overvalued based on current market conditions. Investment decisions should be rooted in comprehensive fundamental analysis, steering clear of emotion-driven choices driven by market hysteria. An informed approach requires considering a company's financial metrics, growth potential, and industry positioning, rather than solely reacting to the movements of institutional investors. Investors savvy enough to maintain a long-term outlook may find themselves in a favorable position. If the prices of these stocks continue their downward trajectory and valuations align more closely with their potential, future opportunities may arise for calculated investments. Remaining vigilant for signs of fundamental improvements allows for better timing and dollar-cost averaging into these assets when they appear more attractive. As we conclude this examination of Nvidia's stock maneuvers, it's vital to adopt a cautious mindset towards panic selling. Just because a titan like Nvidia has chosen to sell doesn't automatically deem Serve Robotics and SoundHound AI unworthy of consideration. Rigorous research focusing on their underlying value is paramount before making any investment decisions. As we wrap up today's discussion, remember that this journey through market dynamics emphasizes the importance of intellectual curiosity. The financial landscape is constantly evolving, and your ability to analyze these shifts critically will empower you as an investor. Don't hesitate to engage in discussions. Share your perspectives on buying, holding, or parting ways with these stocks. Thank you for tuning in, and stay informed for what lies ahead in the market.